Hi, I'm Kenton, and this is Kenton Knows. In this video, I thought I would talk about how I prepare my taxes each year with my accountant, along with some helpful tips along the way. I own and manage 8 buildings with 31 apartments, along with a residential real estate brokerage company. I do all of my own accounting, send out my 1099s and 1096s, as well as separate all of my income and expenses to reduce the time it takes my accountant to prepare my taxes. And as a result, I only pay my accountant approximately $2,000 per year to put it all together and file my taxes. I'm going to explain in detail what I do in hopes that it will help you. If you like this video, please hit the like button and consider subscribing to my channel. Also click the bell so you'll get notified anytime I post a new video, and leave me any comments below as well. To start, I use Tenant to manage my leases and rent payments from my tenants, and I use QuickBooks to manage my accounting. There is a link below to sign up for a free Tenant account, as well as a video I did on Tenant. For accounting, I'd consider checking out Stessa, which is free, even though I've never used it. I use the desktop version of QuickBooks because I have each property set up as a separate company, and the online version requires you to pay for each company, which can add up fast. I also did a video on how I set up my accounting and bank accounts as well. So, to prepare my taxes, I start by creating a spreadsheet listing all the documents and labeling them with a dollar amount and which property they reference. The groups of documents I have are my W-2, all 1098s for interest expenses, copies of my real estate tax bill, lists of any real estate purchases or refinances, the 1099s I've sent out, miles driven, investment account dividend statements or capital gains, and any tax advantage account statements showing yearly contributions such as my kids' 529s or any HSA or other accounts I may have contributed money to for that year. For the refinances, I send my accountant the page that includes all the detailed line items so they can be sure to add the costs and points to the property and depreciate those expenses in future years. When you pay anyone $600 or more in a fiscal year to do work on your property and that person does not have a business, then you will need to have that person complete a W-9 form and then use that information to complete a 1099. Hiring only people that have businesses will allow you to avoid this. But I, of course, have a few people I use to do work that do not have a business, so I need to complete a 1099 for them. The forms are free if you order them from the IRS ahead of time each year. Just be sure you also order the 1096, as the transmittal you'll need to send to the IRS summarizing the 1099s that you issued. Now, for the categories I use all year for my income and expenses. For each property, the income is easy. For the expenses, I'll start with insurance. I have a policy that covers most of my properties, and my insurance broker can split it up and pay it equally with a credit card for each property, so that works out well. I then have an umbrella policy, which is with the same company, so he can do the same with that, so each property essentially pays the same insurance cost each year, and it is billed to the credit card for each particular property. Next, I have a legal and professional fees line. Here is where I put any LLC expenses, and since my properties are in a series, I simply allocate the expense evenly to each property. I will also include any attorney fees, which in Illinois include my tax attorney, who protests my property taxes each year, and if he successfully lowers them, I pay him 25% of the savings, so that cost goes here as well. Mortgage interest paid to the banks is fairly easy to pull from your 1098s. Next is mortgage interest paid to individuals. I have used loans from friends in the past, so when I paid them, I would use a separate line item for that. I haven't used it for years, but I thought I'd mention it in case some of you have private loans. Next, repairs and maintenance. You can have a separate line item for supplies, but I normally just put them all into repairs and maintenance. This could be a box of furnace filters, light bulbs, the HVAC repair person, or whatever else you repair that isn't a capital expense, like a new roof, furnace, or major appliance. Those should be capitalized and kept separate as capital expenses, which your accountant will depreciate depending on the useful life of that item. I'll get into depreciation later. Next is property taxes. Fairly easy. For utilities, I include water, gas, electric, and garbage here. This one can be a little controversial, but I do keep track of meals and entertainment. For me, this is usually if I'm out and running between properties and pick up lunch or a Gatorade, I'll use the property credit card and charge it to the property. My wife and I may also charge a dinner to a property when we celebrate getting a unit rented. We're discussing and planning our rent adjustments, marketing, future renovations, or potentially new investments. My accountant only takes 50% of this line item as an expense. I also have a line item for background checks and another for marketing expenses, which would be to buy for rent signs or listing the apartment on Zillow or other pay sites if needed. If you have a property manager, you'd also have a property manager fee line item and maybe a report from them for all the expenses prepared by your property manager. I don't, so I don't use that line item. I do have a professional fees line item, which is where I put my accountant's costs spread evenly to each property. Next would be the miles driven per property. I actually stopped keeping track of my mileage on my investment properties when we got a third car. We only have 2 people who can drive, so I have one SUV that is solely dedicated to the real estate business and is actually owned by one property. I then simply charge gas and repairs to that company credit card, and I simply keep track of the mileage on January 1 and December 31st to record it in my taxes. That really just worked out well, as we had an old SUV that still ran great and I knew we wouldn't get much for it as a trade-in, but I can just keep my tools in it and don't need to worry about tracking the mileage anymore. One thing I am a little disappointed in is that I am not allowed to shelter any rental income by putting it into a retirement account, as I would if I could. But I can put some of my brokerage income into a SEP IRA each year, and there are some incredible real estate tax deductions, and the ability to take cash out tax-free on a refi is pretty incredible, so it's really not that big of a drawback. Now, why should we itemize each of these line items? It only matters if you have enough income to where you'll save more money by itemizing as opposed to just taking the standard deduction. Assuming you itemize, then what does a deduction or write-off, which are the same things, actually do for you? It's always funny when you hear someone, including Kramer and Seinfeld, just say, write it off, when they clearly have no idea what it means. What it means is that if it is a legitimate expense and you make a profit, then you can reduce your profit by the amount of that qualified expense before calculating your income taxes that you'll need to pay. Put another way, you essentially reduce the cost of the item by your tax rate. For example, if your tax rate is 24% and you bought a $100 item, you still paid $100 for the item, but come tax time, you'll reduce your taxable income by $100, which means that you will reduce your income taxes by 24% of $100 or $24. So after taxes, the item really only cost you $76 because your income taxes were reduced by $24 due to this business expense. It is great to take advantage of the deduction, but it's not an incentive to spend money on things that don't make sense for your business, which is clearly the point here. Next, let's talk about depreciation. This is a big one, but how exactly does it work? To start, the tax code has a schedule which identifies the useful life of each asset, including real estate. For tax purposes, residential real estate has a useful life of 27.5 years, which equates to 3.636% per year. Now realize that land does not depreciate, so first you have to separate the land from the building. So if you purchased a property for $250,000 and the land is worth, say, $50,000, then you can only depreciate the $200,000 over the 27.5 years, which would be $7,272.72 per year. Depreciation is a deduction against your income. So if your property makes a net income of $7,272 after all of your other expenses, but when you include depreciation, you will then have a taxable income of $0, which means you wouldn't pay any income taxes on that income. As your rents rise and the depreciation expense does not, unless you improve the property with capital improvement, and then you can start depreciating those additional improvements. If your depreciation and expenses exceed your income, then you can normally carry those forward into another year and offset future income. Examples of capital expenses would be a new roof, furnace, windows, cabinets, locks, or a refrigerator, and those would be depreciated over various periods of time based on their anticipated useful life. The thing with depreciation is that it is great when you are taking it each year, but it stings when you sell a property. When you sell, you will have to pay depreciation recapture tax, which is to say that the total amount you depreciated will be taxed as ordinary income. Plus, assuming you made a profit on the property, you'll also pay capital gains on anything above your cost basis, which is why you either want to hold your real estate forever and pass it to your heirs, which will then get a step-up basis to whatever the market value is upon your death, or you'll need to use a 1031 exchange to carry all of your depreciation into another potentially more expensive but like-kind property. In summary, I have a summary spreadsheet listing all of my tax documents that I submit to my accountant along with those documents. My accountant supplies me with a package of last year's line items, and I enter the new dollar amounts for each item. The categories I use per property are as follows. 1. Insurance, including an equal allocation per property for the umbrella policy. 2. Legal and professional fees, including an equal allocation of the yearly LLC fees. 3. Mortgage interest paid to the banks. 4. Mortgage interest paid to individuals. 5. Repairs and maintenance. 6. Supplies. 7. Real estate taxes. 8. Utilities. 9. Meals and entertainment. 10. Background checks. 11. Accountant fees. 12. Property management fees if you have any. I personally do not. 13. Capital improvements. 14. Miles driven. 15. Depreciation, which in my case is calculated by my accountant, so there's nothing you really need to do on this. And once you set up your accounting system to have these categories, it's simply a matter of assigning the correct category to each expense. And then come tax time, you should be able to just run a report and you'll have a total for each item per property, which will make doing your taxes much easier. One other thing that I didn't mention that you might want to consider is that if you have a home office and you can calculate the square footage of that office as compared to the rest of your house, and you can allocate some expenses such as your internet, heating, electric bill, etc. to that percentage and use that as a deduction in your expenses because you're using that to manage your properties. But you should probably talk to your accountant a little more about how you're going to do that. I hope this gives you a little more understanding of how I categorize my investment property expenses each year and help my accountant prepare my taxes. Please like this video, subscribe to my channel, and leave me a comment as well. Please be sure to check out my other videos, and thank you for watching Kenton Knows.